Welcome back, Renewable Rides listeners. Today's highlight episode tackles a question we hear all the time from building owners, developers, and finance teams. When does it actually make sense to sell the tax credits from my solar or storage projects? In this clip, I'm joined by Erik Underwood, co-founder and CEO of Basis Climate, and James Coombes, VP of Business Development at Conductor Solar. We break down the fundamentals of tax credit transfers, from how pricing really works to why timing, registration, and transaction costs matter far more than most people expect. Erik walks us through a simple example that puts real numbers behind the decision to sell credits, while James explains how deal structures and risk look very different for smaller projects compared to utility scale transactions. If you've ever wondered why companies sell tax credits even when they have tax liability, how buyers think about underwriting and risk, and what it actually takes to turn credits into cash in year one, this is the place to start. Let's jump in. That, as you know, resonates quite strong with how we see the world on getting projects to the point of wanting to transact and pursue those. So love what you guys are doing there. Well, let's, for our listeners that may or may not be familiar, Erik, can you just give us the basics of tax credit transfers? Why would a business consider selling their tax credits? When does it make sense? When doesn't it?
Yeah. So for tax credit transfers, let's start with the tax credits for any of these energy projects. The U.S. has incentivized renewable energy development through tax credits. On the transfer side, this was enabled through the IRA, where you could simply sell these without creating a partnership or sale leaseback structure with a tax liable investor who had to really get into your project or into an operating company or an asset company, as it were. So this means you could sell the tax credits from just one project. There's technically no minimum of the amount of tax credits. What the IRS did do, and what the legislation of the IRA did, was to create some good safeguards for the industry to be able to define the qualification of a tax credit. And as much as the IRS doesn't like to prescribe volume or valuation matters, they did, basically lay the groundworks for the transfer universe, following by general rules of, cost basis of investment tax credits. Or volume basis of production tax credits, similar to the last 20 or 25 years that we've seen. So if I'm a developer and I'm building, let's say, one rooftop solar project on a building, and it's, let's call it $1 million, just to keep round numbers, of solar panels, generally I should be able to sell those at least 30% of the cost basis, of the eligible cost basis of those credits. And so that will then let me monetize, what is $300,000 worth of credits by selling them to a buyer. However, that buyer could just spend $300,000 on taxes. So they normally would like to take that tax credit and buy it at a discount. And this is where the market can vary a lot, depending on volume, depending on timing, depending on counterparty comfort. And so generally we see, around 80 to 90 cents, and there can be a 5 to 10 cent delta on the lower end of that for investment tax credits. And the top end of the market, if you're doing $100 million deal, you can get, a few cents above 90 cents on ITCs in the best market conditions. And so you sell these at a discount, so that $300,000, to keep this round again, you would sell it, let's call it at a 10 cent discount, so 90 cents on the dollar per ITC, and you would get $270,000 in cash for that 10 cent discount tax credit. However, there's also transaction costs, and there's parties that are making this happen, and so sometimes you'll see 2, 3 or more cents for the combination of lawyers and advisors or platforms such as Basis doing the transaction costs. We're always very transparent on what the estimated net proceeds are off of any transaction that we do, because we think it's really important. This is a dollars and cents transaction. Let's be upfront at the beginning on how much this should cost, and let's make sure that variable fees are capped so that you don't have $100,000 of legal spend on a $300,000 credit. That would make no sense to anybody. And so then that's generally it. The IRS also has some really important registration points that I would say in terms of making sure that there's no fraud in the system, because you're only allowed to sell the tax credit once. You need to sell it within the same tax filing year that the credit was generated. And you must register the credit on the IRS Clean Energy Credits and CHIPS platform. It's the same platform to register the credit, which is tied to the facility and tied to you as the initial taxpayer who owns that credit, who owns the project that generated the credit. The buyer needs to see that registration number before they file their taxes as well. So that's a really critical point, and that can take up to 4 months in current market conditions of how long it takes the IRS to provide that number. Even though it should seemingly be a simple process, there's a huge volume of credits that are being registered. And there's, sometimes it feels like an army, sometimes it feels like two guys in a room at the IRS processing these. So then you have a tax credit transfer agreement that is executed in there. There's a transfer election statement, and tied to the transfer election statement are your IRS registration numbers for the facility or multiple facilities if you're transferring more than one.
Excellent. James, anything you wanted to add to that overview, or should we start to dig into the details here?
So I'll highlight that how that process looks, what's required, even how deal terms and pricing look, varies significantly from the large and utility scale transactions that Erik touched on to the smaller end of the market. And so speaking from the perspective of small credits, which without a precise definition, credits in the $200,000 or $300,000 range to definitely upwards of $1 million, $2 million range or more, they're subject to a more specific set of requirements and also limitations. So one of the things you hear a lot in these conversations is tax credit insurance. That has, at least customarily and historically up till now, been a large insurer product for larger projects that comes with upfront costs and significant policy costs. And so for smaller projects, that's typically, instead of tax credit insurance, we'll see personal guarantees, parent guarantees, fundamental underwriting of the business selling the credit, and in some cases, a letter of credit, at least as sort of a crossover or an alternative to tax credit insurance. So there's more to highlight there, but just broadly highlight that everything from underwriting, pricing, terms, types of buyers will vary significantly for smaller projects versus medium and larger size.
Nice. And I'd say most often when I hear this come up, it's from entities that don't necessarily have any tax burden or don't have enough tax burden to take advantage of the tax credits that they have. But maybe you can share with the listeners, why would a business that does have a tax burden consider selling their tax credits on the front end of a project?
What we normally see is there is a lot of cost related to the credits, and many of these projects are upfront costs and longer term savings, right? So oftentimes when somebody's looking at doing a single site, either as a homeowner on the rooftop, if they're buying it, this is until end of 2025, or if they're a small business that's looking to do it, they're looking for that payback period. And that payback period can be a combination of just like the energy savings that they're getting by having on-site power versus relative to the upfront cost. Similarly, if you're a project developer, you would also have, a high upfront cost for these projects, but then much smaller operating income from the revenues generated by that project. And so that plus depreciation calculations ends up meaning that normally, anybody can develop it. They don't have to transfer their credits to get the credit. They can hold on to them. However, and they can carry those credits forward for 22 years. However, it doesn't make sense because oftentimes it's going to be 7, 8 or more years before you actually start benefiting from that credit because of the depreciation NOL balance that you're using also as a deferred tax asset. So this is getting accounting very quick, but basically your operating profit from your project or the economic benefit from that project normally will not outweigh being able to sell it at a slight discount on a net present value basis.
Yeah, so the more you can, if we treat the tax credits just like another form of cash flow in the project, the more we can recuperate all of that cash flow in year zero or year one, the better our net present value of the project
like
is.
A lot of people are thinking of this like, what am I out of pocket that first year, right? If it costs $1 million, boy, it would be nice for me to only have, to still have already recouped 270 or 250 in that first year. There's a working capital timing difference, of course, but like you can see that payback really quickly. And you have the benefit of there being an urgency to get it done that first year because the buyers can't buy it after that first year.
Mm-hmm. Mm-hmm. Well, so when we're thinking about that, like if I'm a business owner and I've got, a dozen facilities and I'm considering, safe harboring these projects as we get ready to close the year, what do buyers of systems, sellers of credits have to do, or what requirements do they have to meet in order for a buyer of these credits to be interested in securing them? Because there's all kinds of nuances around recapture risk and other components of that. James, how should I, as a buyer of an energy system, potential seller of a credit, like what are the paperwork? What are the things that I need to have in place in order for it to be attractive for someone to buy these credits?
Great question. If I can answer that with a slight rewind to the question you asked before this. So if I'm a business seller considering a solar project, and we have these conversations in development stage, construction stage, and post operational stage all the time, you're evaluating. We used to I coined it the matrix years ago when I was at SunPower. If you think about, there's two key financing decisions you're really trying to talk about. One is, where is the money coming from? And then two, where is tax credit monetization coming from? So if you think of it as a 2x2 matrix, and with capital access on one, do you need the money or not? Do you already have it budgeted? Do you have internal cash, or do you need to procure the money? And the other axis being, do you have tax liability or not? So if you've got the money and the tax liability, you're a traditional cash buyer. If you have the money but not the tax liability, this is where we would say, hey, this is a great opportunity. You pay cash and sell the tax credit, or borrow on your credit line and sell the tax credit. If you've got tax liability but not capital, then that's a loan. You can borrow the money and then monetize the tax credit, or a scenario where you're looking for both, not necessarily because you don't have capital. Investment grade companies certainly have capital, but you could have a lot of reasons you'd look for standalone project financing. That's a PPA or a lease project where somebody's providing the capital and monetizing the tax credit in a combined vehicle. So a lot of our projects organically start with strategic discussion on that front. And then clients will often decide, hey, look, I can potentially take the tax credit, but it's going to involve some uncertainty on my income. We deal with a lot of ag clients who have a cyclicality that's different from the cyclicality that other industries will be familiar with. And we also may need to carry it forward for a number of years. So on a present value basis, we don't have to sell it to get some value, but we could sell it to maximize value, timing, risk, and some equation there. So for clients that know that they need to monetize and a project is dependent on that, the market is now visible and liquid enough that you can give good visibility. And we do, even in advance of like bringing our clients on board, we'll do a screen to advise on sort of what's the right transaction for you. Do we want to both engage to do this? And so you go into flashing forward, you go into the tax credit sale process already sort of having a fallback on valuation if you couldn't sell it. So that's how the decision's made, at least in our corporate kind of owner user customers. There's a whole class of investors, special purpose entities that fully expect they're going to sell the tax credit. That's largely not who we deal with, but that's a relevant universe for this discussion that I think Erik deals frequently with. And then to quickly round out to the what is required question. On the front end, we always advise your contractor, you need your standard tight completion package that'll have all the warranties and diagrams and everything. And the one thing we recommend you get is a cost breakout from the contractor. It's easier to request that when they haven't been paid and punched out. So that's ready to go. You may not use that for a period of time, and there may be questions when we go for cost seg reports. We'll get to that. That's how we substantiate basis. But requesting that on the front end from your contractor, and we have a template we use that's consistent with what a lot of the major financial firms we work with require.
We receive a lot of questions from business leaders around the world wanting to learn more about the energy transition, what is possible, and where to start. So to help you stay informed and up to date on best practices, opportunities, risks, and success stories, we created an industry newsfeed at VECKTA.com/news with all our podcasts, blogs, and newsletter. Check it out and connect with Dan, myself, and the VECKTA team to learn more. Cheers and have a good one.